A very good evening to all my dear MOS members, those who have joined. And I think we have already passed on the link. So those who are within the group can pass on the message link and the meeting ID to all the different groups we are in. So people can benefit. Today, friends, as the part of our MOS, I am admitting a Viral, you keep admitting because it's just popping up the message in between.
I'm admitting, sir. Don't worry.
Yeah, so I'll be concentrating on the talk then. Those who have got the links, please pass it on to different groups so more people can benefit. In the meantime, as I just said, the MOS has started the literacy, the financial literacy series. This is the fourth in that, in where we have a renowned chartered accountant, Arpita Gupta. She had already taken one of our webinars. It was liked by lots of people, and that's why we have come up with another topic, something equity based. I mean, better than equity, but less volatile and more than FD. That is what the topic today is, and she's going to highlight how to go about it. We have a star moderator, Dr. Viral Shah, the chairman scientific committee of the Vidarbha Ophthalmic Society, member scientific committee of Maharashtra Ophthalmological Society. And with us, we have a star invitee, past president of the Bombay Ophthalmic Association, and a very good guide to all of us. He is one of the star person who has guided us throughout, and that is why this investment group has been formed on his request. We have not one but two. Majority of them are ophthalmologists who really would like to have a view. He is strong in his fundamentals, and whatever he recommends, none of them have had a loss in this. And today he is also giving us the expert view. Once the CA Arpita madam finishes her talk, we'll have a good question and answer session also, which is going to give a good insight to all the ophthalmologists. If you are worried about equity, we have another alternate way to go about it and how to do. I hand over the mic now to our moderator, Dr. Viral Shah, to introduce Chartered Accountant Arpita Madam. I am extremely grateful that you have accepted the invite and given a very interesting topic, which you are going to tell us all about. So over to you, Viral.
Thank you. Thank you so much, President Dr. Jignesh Taswala, sir, for this wonderful initiative of financial literacy for our doctors, all doctors of MOS. And it's my privilege to present to all of us today's speaker, CA Arpita Gupta. She is a chartered accountant and she is a certified financial analyst level 1 from USA. She is a director of niveshmitra.com and also a regular columnist at Money Control and CNBC TV 18's channel. She is working as a wealth and investment advisor to clients from varied backgrounds like doctors, NRIs, non-profit organizations, army veterans, and businessmen. Arpita has been invited to conduct personal finance and investing sessions for the Indian Medical Association, top surgeons and gynecologists and radiologists of India, IIT and IIM alumni, army veterans, architects and corporates like Infosys and all that. I am sure we are all waiting to hear from CA Arpita. So without wasting much time, we directly go to today's topic. CA Arpita, welcome to this MOS webinar on financial literacy.
Welcome, ma'am.
Thank you so much. Thank you for having me for the second time. It is completely my pleasure to actually address such a wonderful audience. So I'm just sharing my screen, and for all of you who've attended the previous session, they all know the drill. So we begin with the PPT and I try to educate on the current topic, and you can have your questions in the chat box. I'll try my best to take all your questions in the chat box. If not, at the end, we'll open for audience Q&A. So you can wait till then, and we'll try our best to answer all of your questions. It's going to be a pure educational session. So I hope you all go back with a lot of value addition today. So equity like returns, but lower volatility, better than FD returns. So everybody wants good returns, but do not want to take risk. So this is something that, everybody is struggling with. Everybody wants this, that I don't want to take a lot of risk, but I want good returns. FD is too low. So the problem is the inflation is really high. We are in India sitting at high inflation. We're reading about it every day in paper, not just today. In fact, if you see 5 years, 10 years, last 50 years, inflation in India is around 6 to 7% per annum. And recently, the last 2 years, we've been struggling with low bank FD rates. So the bank FD rates have been as low as 5.5% per annum. So this is the biggest problem. Now, what is the current inflation rate in India? The biggest question. So we discussed this during the last session also. For all of you who didn't attend the last session, we'll just do a little brief and tell you exactly what is the rate of inflation in India. Why is this important? Because, you know, inflation is the rate at which your cost of goods and services, cost of living, cost of monthly expenses, whatever you buy, grocery, education, college fees, medical expenses, whatever, they're all linked to this. And to maintain the same standard of living, to maintain the same basket of goods and services that you want to buy, it's increasing every year. This is basically inflation. In India, inflation rate is 6 to 7% per annum. This is announced by the government of India in the name of CPI, but it does not include education inflation, which is almost 1.5 times of what the government of India announces as the inflation rate. So CPI, the government of India keeps announcing this inflation rate that is applicable in India, but they do not include the inflation that is faced by college expenses that are rising, or higher education that fees that is rising. And then there's medical expenses. You all know it better than me that medical expenses, cost of treatment, medicines, they're all rising really, really fast, and it is rising in double-digit figures. And there's something called lifestyle inflation. We've all started having a refrigerator. Refrigerator is no longer a want, it is a need. 25 years back, it was a want. It was something not everybody had, but now a refrigerator is a common thing. Flight travels are much more common. Smartphones worth 70,000, 80,000, so much common. Air conditioner, laptop, smart watches, AirPods that you're using. So this is all basically lifestyle inflation. So when you include all of that, inflation in India is at least 7 to 8% per annum. So you can actually see it. This is the rate at which the cost of petrol, the cost of commutation, your grocery expenses in the form of dal, chawal, simple. It is actually, if you actually see the rate at which it is increased, it is 7 to 8% per annum. And that is exactly why we're all sitting here, that, I need more money every year to maintain my standard of living. And that money, the money that I need, it is actually increasing by 7 to 8% per annum. So whatever money I'm parking as investments, they should ideally at least match this. And in fact, better if it can beat it. But I do not want to take a lot of risk. So we're going to take this in point today. How can you actually beat inflation, or create inflation matching returns, or beat bank FD returns, but without taking a lot of risk. So the problem with bank FD, the bank FD current rates are around 5.5% per annum. And I'm sure all of us here, sitting here with my audience, you're all are at least under the tax bracket of 20 to 30%. I'm sorry, I think I got muted. Okay, so that 5.5% per annum bank FD rate actually translates to 4.5, not more than 3.5 to 4.5% per annum. So anything that you're parking in your bank FD is growing at 3.5% per annum, maybe, but your expenses are rising at 7%. It is almost double. So we'll actually try to discuss a lot of products that are giving you better than FD returns, the pros and cons of each, and what is the secret sauce of investing in all of these products. Number one, the best product that all of us, and especially, so I have an experience of working with a lot of doctors to take care of their investment portfolios. And this is one thing that I've seen in common, that a lot of doctors actually have senior citizen savings schemes and post office MIS in their investment portfolios, definitely. The reason being, bank FD is 5%, but senior citizen savings scheme, POMIS, they're giving around 7.5% per annum. So that is almost plus 2% than a bank FD. This is government, this is guaranteed. So completely safe, negligibly low risk, and the returns are much better than FD. So let's just go for that. The limits are 15 lakhs, 9 lakhs. But is it really good? Let's actually do the calculations and understand a little, inside the envelope. I understand you're all from medical field, so I'll try to make it as simple as possible in simple English language without using a lot of mathematics or, financial jargons. One thing that we need to understand is senior citizen savings scheme and POMIS actually works on simple interest. What that means is, we've all read in high school. I don't know if you all remember, simple interest versus compound interest. Simple interest is basically when you're not earning interest on interest. But in compound interest, you're earning interest on interest. Okay, so just to give you a simple example, if inflation today, if you're buying something at 100 rupees today, and the inflation is at 7%, next year it will be 107. The year after that will be 107 plus 7%. So this is compound interest. So inflation in India is at 7% compound interest. Now, when you park a bank FD at 5% per annum, so, and you do it for maybe 5 years, sorry. So you maybe do it for 5 years, 5% bank FD, 100 rupees. 100 rupees you park today, you park it at 5%, next year it will be 105. Next year again, it will be 105 plus 5%. Then again 5% over and above the entire amount. So this is basically compound interest. So whatever interest you earned in the first year, that interest is also reinvested at 5%. Now here comes the detail. Senior Citizen Savings Scheme, they claim on the envelope that the interest is 7.5% per annum. But this is simple interest. So why is that a problem? That means whatever interest that I'm earning in the first year. So Senior Citizen Savings Scheme, also the lock-in period is 5 years. So if I park today 15 lakhs, in the first year, I get 15 lakhs at 7.4%. The second year again, I get 15 lakhs at 7.4%. So the interest that I earned in the first year is not reinvested at 7.4% per annum again. So this is something that we need to take into account. Is it really a big deal? Do I really need to put in so much brains on such a tiny thing? This is the difference it can make. Senior Citizen Savings Scheme, if you invest 1 lakh today and it is giving you a return of around 7%, looks very attractive, much better than bank FD, 2% higher than bank FD, guaranteed. So that 1 lakh in 28 years becomes 3 lakhs. So it looks very lucrative. In around 30 years, you've made 3 times of the money. Versus a bank FD, wherein your interest is also reinvested at 7%. That 1 lakh becomes in 30 years actually 8 lakhs. So this is a difference of almost 3 times. The difference is really huge. The only difference is tiny. The tiny difference here is this is simple interest, this is compound interest. So the returns are the same, 7%, 7%. But actually, when you see the detail, Senior Citizen Savings Scheme, POMIs, they all work on simple interest. That means your interest is not reinvested at the high rate. And actually, what that means is Senior Citizen Savings Scheme, POMIs, are creatively marketed products. You need to understand government is also not a fool that, if bank FD is at 5%, why in the world will they give you extra 2% that to guaranteed, to everybody with 15 lakh of limit. So that is a huge limit. The entire idea is it is a creatively marketed product. The creative marketed product, that means that 1 lakh becomes actually 3 lakhs only. So a Senior Citizen Savings Scheme at 7% is essentially equal to a bank FD at 5%. Only on the envelope you see it is 7%, but actually what returns do you actually get is equal to a bank FD at 5%. So we understood, a while back that bank FD, the problem again is, I'm getting 5%, but inflation is at 7%. So again, that is one major reason that I always recommend a big no for Senior Citizen Savings Scheme. We're basically fooling ourselves with the high rate that we feel that, we're getting, but we're actually not earning that kind of return. We're actually just parked that 15 lakh, blocked it for 5-7 years, whatever, into a bank FD product, but just mentally fooling ourselves with higher returns. So again, if you think better than bank FD, Senior Citizen Savings Scheme, at least utilize that 15 lakh for every person in your, for you and your spouse, it is actually a bank FD product. One thing a lot of doctors actually end up going for better than bank FD products are guaranteed return plans or pension plans. And these are the most sold products to medicals. What does it offer? They're basically that, you can just pay an annual premium. They're offered by life insurance companies like HDFC Life, Kotak Life, LIC, all of these companies. And what they say is just pay a premium amount, either today, the entire amount, or just pay the premium amount every year for 5 years or 10 years, whatever. And then once you retire, once you become 50 years, 55 years or 60 years, you will get a monthly pension or monthly fixed income till the time you're alive, or 3x of the amount that you've invested, whatever. So when you actually see, these are the marketed lines. Now, what is it inside? Inside, it is actually giving you bank FD returns. So the thumb rule all the time, whenever you're analyzing or you're investing into a product, the thumb rule is understand what is the return in percentage term that you're getting. Not, I don't want to understand if I'm getting 3x or if I'm getting 20,000 per month. I want to understand if I'm investing X amount of money today, what is the return in percentage term that I'm getting? And then you actually understand that these guaranteed return plans or pension plans offered by any company that you get me, HDFC Life, ICICI Pru, Kotak Life, LIC, they're basically again creatively marketed bank FD products. So they're again giving you returns not more than 5 to 6% per annum. Now, some of you might actually ask me, what is the problem? If I'm getting a 5 to 6% per annum, that to a guaranteed income, what is the problem? The problem is inflation again is in India is at 7%. The rate at which your cost of living is increasing. And this you cannot avoid. This is unavoidable. This is applicable to each and all of us, and it is completely unavoidable. So the inflation is at 7%, your money is growing at 5%. So there's a huge gap. And what does this lead to? This leads to during pension times or retirement times, or after you actually come out of your investment period, your monthly expenses end up being more than guaranteed pension income. So you have to sizably reduce your standard of living and substantially reduce your monthly living expenses if you're depending just on a guaranteed pension plan. The only reason is your cost of living is rising faster than the rate at which your money is invested. So this is again a problem. Now the third product that everybody is excited about is better than FD is PPF Sukanya Samriddhi returns. So they're basically offering you 7.5% per annum post-tax return, which is actually very lucrative. Now, if they're giving you 7.5%, that is equal to the rate of inflation in India. So if you're thinking that you're making good money, you're not making good money. It's basically zero real return, no profit, no loss situation. So it's not bad like bank FD, but it's not great also. It's an average yielding product because you're getting a guaranteed income, but actually in real terms, you're not making any returns. Now, what are the other options for actually generating returns or, small real return? At least I should make some positive real return. I should be able to beat a little inflation. But again, I'm a faint-hearted. I don't want to invest into equities, my entire money. I've invested some SIPs, but I don't want to invest everything into equities or mutual funds, whatever. Is there a better alternative? So in financial world, these products are called absolute return strategy products. These are basically debt plus returns with similar risks, or equity minus return. So if equity is giving you 12%, they'll give you equity minus return with lower risk. The ideal time horizon, this is the number one secret sauce of investing into these products. The ideal time horizon for investing into these is 3 to 5 years. So you have to stay invested for 3 to 5 years. There's no lock-in. There's no statutory lock-in for these products. So you can actually get out of them after 3 months also, or after the next day also. But the secret sauce of investing into them is you have to stay invested for 3 to 5 years for them to actually give you inflation matching or beating the inflation a little. They are very, very popular amongst HNI and institutional investors. So HNI institutional investors, ultra HNI, they are handling big corpses of money, and they don't want to invest the entire capital into equity. So they're very popular here. They have very low correlation with stock market, these absolute return strategy products, or ARS we'll call them. So ARS is basically what we call them. So ARS, very low correlation with stock markets, equity like returns, but with lower volatility. And what they do is they increase your returns of the entire portfolio without increasing the risk also that much. So if you add equity to your portfolio, the risk is and return both go hand in hand, but these increase the returns, but the risk is not increased by that much. Now, ARS are offered by 3 investment options, investment vehicles. Number 1 is AIF, EMS, and then mutual funds. AIF are basically alternative investment funds, and they are ideally good for ultra HNI clients and they need you to invest at least 1 crore. So you need to have at least 1 crore when you're investing into them. PMS is a small version for that. So you can start investing into a PMS offering ARS strategy with as low as 50 lakhs, and something that is accessible to all of us. And I'm a strong believer of mutual funds. So mutual funds also have ARS strategy. They also offer ARS strategy with investment amount as low as just 1,000 rupees. So you can invest into an ARS by as low as 1,000 rupees. The biggest benefit of mutual funds, and I would recommend mutual funds for people even with bigger corpus, even if you're an ultra HNI with investable surplus of 1 crore, 2 crore into an ARS, I would strongly recommend mutual funds over AIF and PMS. The only reason being, it's very difficult to get the historical data analysis of AIF and PMS. While mutual funds, the transparency is much, much higher because SEBI is involved here. So these are something really good to look at. For the uninitiated, what are mutual funds? Mutual funds are basically when a pool of investors across India, pan-India investors, they pool their money, they hand it over to a fund manager. That fund manager then further invests into stocks, corporate FDs, securities, and then whatever return is then generated, it is then given back to the investor. Contrary to popular beliefs, mutual funds do not just invest into stock market. There are types of mutual funds. One type is equity mutual funds, which invests only in stock market. The second type is a debt mutual fund that invests into corporate FDs, bonds, debentures, basically fixed income products. And the third option is hybrid mutual funds. So they're basically, as the name suggests, they invest in both stock market also and bank FD or corporate FD or bonds, debentures, RBI bonds, all of this. So in simple terms, ARS in mutual funds are hybrid mutual funds, and they are a very good idea for actually lifting up your portfolio returns without increasing the risk substantially. Now, hybrid mutual funds, we discussed the number one secret sauce to actually benefiting out of them, getting success in them, is your ideal investing horizon should be 3 to 5 years. There are around 200 plus hybrid funds in India. So they're basically ARS. So around 200 plus hybrid funds are available. Hybrid mutual funds are available in India, offered by big financial institutions like HDFC, ICICI, Kotak, SBI, L&T, DSP, big foreign investment advisors, BlackRock, all of them, they all have hybrid mutual funds in India. They're basically, if you want to understand the essence of it, they're investing into stock market also. If you invest 100 rupees in a hybrid mutual fund, so they will invest some portion of your money into stock market also. They will invest some portion into risk-free RBI bonds also, some portion into bonds and debentures of big companies like Reliance, TCS. And that is how they mix and match and create a better return for you. They will invest in gold also. So there are broadly 4 categories of hybrid mutual funds. One is conservative hybrid fund. They're basically conservative as the name suggests. So at least 75 to 90% is invested into debt. Debt, that means fixed income. So we all know when you're investing into fixed income like RBI bond or bonds and debentures of top rated companies like HDFC Bank or Reliance, TCS, Infosys, Maruti Suzuki, Pidilite, Asian Paints, whatever. So, bonds, debentures of them, they're basically physical fixed income instruments, and they are comparatively much, much safer. So as the name suggests, conservative hybrid funds invest substantial portion of your money. So if you're investing 1 lakh, 2 lakh, 10 lakhs, whatever, at least 75 to 90% of the money that you're investing is invested into fixed income products. The remaining is into equity. What they do is, the entire idea, the logic behind is, they'll invest some portion into fixed income to give you stability so that your returns don't fall down a lot. And they will invest some portion into stock market so that you get FD plus returns. There's a little alpha in your returns, or you get a little 2 to 3% extra than your FD. So even in case stock markets don't perform well, then the fixed income instrument like RBI bonds, they will hold the returns, and they will make sure that there's no loss. So this is how they contain the risk, or they'll contain the volatility. Now, aggressive hybrid funds, as the name suggests, they invest into, majority of the money is invested into equities. Balance advantage fund is basically they invest according to the markets. So जहां मौका मिलता है वहां चले जाते हैं वाली बात है. So balance advantage funds, if they feel that equities cheap or stock markets are cheap, They will invest majority of their portion into equities. And that's how they keep balancing it. And multi-asset allocation funds, here again, they invest in both debt and equity, but they will invest into gold also. So if you want to invest a portion of your money into gold also, then multi-asset allocation funds are good. And the beauty here is, if they think, the fund manager thinks that gold is going to do well, he will invest majority of a portion into gold. If he thinks equity is going to do well, he'll invest a majority of a portion into equity. Or if not, he'll just balance and put some amount in all the three cycles, so you get a balanced return. So this is a very big beauty of this product. Now, just to share with you, how can it actually increase the returns but not the risk? I told you the secret sauce is staying invested for 3 to 5 years. So this is one of the data points of one of the hybrid funds, actually hybrid mutual fund. And what we've done is, if in the last 15 years, listen to it carefully, it's very simple. If in the last 15 years, you invested on any date and you stayed invested for exactly 3 years, even if you were the unluckiest investor in this hybrid mutual fund, you would have come out with plus 5% per annum. So even in the times of the worst market scenario, you came out with positive returns, plus 5% per annum kind of returns. As soon as you increase your time horizon to 5 years, in fact, even if you were the unluckiest investor, that worst return went up to 6.5. And you can see the average return when you're holding it for 3 to 5 years is approximately 10%. So a return of 10% is very, very achievable. It is not at all ambitious. And this is the comparison when you compare it with equity. The orange line is an equity or a stock market, and the blue line is a hybrid mutual fund or an ARS product. So you see, when in March 2020, when we had COVID market crash, equity or stock market gave a negative return, which we are all scared of. But if you would have invested into a hybrid mutual fund that time, you would have come out with plus 6% per annum. So even if your worst return is 6.5% per annum, your average return is 10%. And of course, if the markets are good, then you get to participate, and your highest return can go as high as 13% per annum. So what more do you want? If the stock markets are doing well, you're participating in their return, you're participating in getting good returns. If the stock markets are not doing well, the fixed income portion of your hybrid mutual fund is holding up your portfolio, and your portfolio returns are not falling down, or they're getting at least generating at least positive return. There is capital protection, but beyond that also, there is some level of income generation at least. That is also in the worst case scenario. Okay, what is the taxation like? So taxation is basically debt plus return. So these are basically, they give you better returns than your bank FD, but so return is also better, taxation is also less. So, these are both wins basically. So in your bank FD or your RBI bond, how you're taxed is basically you're taxed on your tax slab. So you're in 20% tax slab, 30% tax slab if you're paying your income, your medical income, and the tax rate that you're paying is 20%, 30%, then that is the rate that is applicable on bank FD. But if you're investing into a hybrid mutual fund, you're paying much lower tax. You don't have to pay tax at 20%, 30%. You have to just pay tax on the whatever profit that you've got, and that too 20% after indexation. So net it comes to around 15%, honestly. So 15% taxation in hybrid mutual funds versus bank FD is asking you to pay 20 to 30% taxation. What kind of difference does it make? You can see the difference. The return number one is higher. So return is, at least in the current scenario, you can expect 7 to 10% per annum, depending on the category of hybrid mutual fund that you're investing into. So if bank FD is at 5%, in hybrid mutual fund in the current scenario, you can expect 7 to 9% per annum. The liquidity is immediate. So that means you can just immediately access your money whenever you want to. The tax rate is, in bank FD, you have to pay tax rate at the same rate at which you're paying for your medical income. So 20%, 30%, whatever. But in a hybrid mutual fund, you have to pay tax as low as 20% after indexation. How can you quantify? How can I help you quantify? This is the quantification. So even if you're investing 10 lakhs today in both bank FD and hybrid mutual fund, and just for the sake of simplicity, even if the returns are the same, In a hybrid mutual fund, you have to pay tax as by tax lower tax by 1.5 lakhs. So in a bank FD and hybrid mutual fund, if the return that you're earning is the same, in bank FD you'll have to pay 1.83 lakh for the same kind of return. But in a hybrid mutual fund, you'll have to pay just a tax of 30,000. So that is basically a saving of 1.5 lakhs. So, your returns are also much higher in a hybrid mutual fund. Here, 5% versus 7 to 9% per annum. So the returns are also much better. And in bank FD, the taxation is higher, but in hybrid mutual fund, the taxation is better. So, it is basically a win in both sides. And that is a strong reason why we recommend you to invest into a hybrid mutual fund. I think with this, we can end the session. Just a brief about me, as Sir mentioned in the beginning of the session. So basically, I'm a chartered accountant, but I'm working as an investment advisor by profession, heading niveshmitra.com. We're a well-tech company. And because of the experience that I owe with, working with a lot of doctors to take care of their investment portfolios, that is why I thought that this, would be a, relevant topic for you all to know. And this is something as a most asked question to me as an investment advisor. Just a little about our company. So we're a well-tech company and we help you manage your investments and financial goal planning. And for that, we deal in all kinds of investment assets: government, corporate bonds, listed equities, unlisted equities, mutual funds, PMS, AIF. And because we're a well-tech company, we work with a rich experience of clients across India, pan-India. So, doctors from across India. So that is about us. So just a little educational initiative by our company. This is something that we use as a WhatsApp newsletter, basically. And we try to educate all our subscribers with small money tips and articles to help you invest, take better investment decisions, and grow your money IQ. It is very simple. It's completely free of cost. You can join. So you can just save this number 9111006340 in your contacts and send *0 to this contact on WhatsApp. So this is how you can, be a part of our WhatsApp newsletter. I think we can open the floor for audience Q&A. If the moderators for today, Dr. Viral Shah and Dr. Ramesh Shah, and Dr. Taswala, if you can help us take the audience.
Definitely. Actually, it's a very interesting talk that you had. I think you have covered it in a very nice way. What exactly a person has to do and why it should be done. Your explanations are also to the point. So now I think if you have questions, one, I think the question which has been asked is explain about indexation. Exactly what does indexation mean?
So I actually, skipped that 20% after indexation. But what they say in very simple terms in English language is that, if your hybrid mutual fund is giving you a return of maybe 9%, and during the same time, inflation was 7%. So you have to pay tax only on 9%, the return that you got, minus inflation. So, in a bank FD, you have to pay tax on the entire 9% return. But
Right.
in hybrid mutual fund, you have to pay tax only on the return that you earned over and above inflation. So, your gains, taxable gains, are basically substantially low.
Perfect. Dr. Ramesh Shah is a special invitee. He is very much in stock markets also. I would like to have his view on this presentation and anything you would like to share with the audience or any question you'd like to ask. Ramesh bhai, unmute please. Unmute yourself.
Unfortunately, I am not probably with any of this mutual fund business because I don't believe in mutual funds. I always believe in direct investment, which usually gives, if you are selecting proper things and if you are ready to wait for 3 to 5 years. See, what is happening is that you are ready to wait in mutual fund for 3 to 5 years, but nobody wants to wait when they invest in stock directly. So I always believe that mutual fund is not giving a proper returns. If you want a wonderful returns, I think the direct stock investment is far superior. And you have seen last 2 years back when we gave the whatever few companies, people have made nearly 100% profit per year. So I am not the person in this forum who can speak about the mutual fund. Neither FD, none of this category. The only thing which I wanted to tell you about the indexation is the 9% is not 9% minus 7%. The indexation figure is given by the government. So even though you are paying less, but it is not 9 minus 7, that means 2. No. It is the indexation which is prescribed by the government, and that much amount you have to give less. It is not 9 minus 7.
Yes, of course. So this is basically just for general explanation.
Yeah.
The actual calculations will be taken. So I don't think the medical background can actually help you understand the CII index and everything.
No,
So that
madam,
is why just to simplify it.
You are underestimating the doctor's knowledge
No,
about.
not underestimating, just for
I think
young doctors.
99% of the last
underestimating.
99% of the doctors, they know their finances, they know their
100%, completely agree. I was just
they
trying to
know what is
simplify
indexation
everything.
and everything they know about it.
Yes,
Most
so
of the doctors
no
are
offense,
extremely
honestly,
well read.
don't.
In last 2 years, I observed in most of the groups, I think their selection of scripts has been far superior than any of these fund managers. I have seen them. They are wonderful.
Completely agree. So there's no offense about it, honestly. Don't take it in the other way. The only thing is I wanted to simplify it. Of course, there are CII indexes. I don't want to delve into that depth. The entire point was I wanted to, help just across the idea behind it and not get into the mathematical collection. So that is what we're exactly here for. We're not here to understand the exact mathematics. We're here to understand the entire idea and concept behind things. So instead of calculating exactly 91.5, I'm helping people understand you'll come at 90. So just to simplify.
Madam, more questions is regarding the hybrid mutual fund. Is this applicable only to hybrid mutual fund or anything else?
So
there is a question being asked.
Yeah.
On
So
the chat box.
we're trying to talk here about investment products which are equity minus return. So of course, completely agree that stock markets, direct stocks or equity mutual funds can give much better returns. But hybrid mutual funds, they give lower returns than direct stocks or equity mutual funds, but they contain the volatility also really well. So I cannot say that for any particular stock that, for example, ITC, it is such a big stock, but it is still negative return even after holding for 5 years. But that is not the case for hybrid mutual funds. So the entire point I'm here trying to make is if you're investing into a hybrid mutual fund, the risk is substantially low. So if you can stay invested for 3 to 5 years in a hybrid mutual fund, your returns are actually, even your downside is capped really well to plus 5-6% per annum. So this is particularly to hybrid mutual fund I'm talking about.
What is your view on these new silver mutual funds which are floated by ICICI Bank? Because that is one thing which none of us have understood so well.
So we took this question, in the last session also, this was a lot asked about gold and silver because actually, we just had gold ETFs till now, but silver has actually been, the new talk of the town because of its industrial use. But according to me, honestly, the entire idea when you're investing into commodities, you can, over a period of 10 years, they're basically inflation matching returns. Of course, there are abnormal returns in some years. So you can, maybe in 2-3 years, if it gives you 40% kind of returns, but over a period of 10 years, they're basically inflation matching returns.
Quite right. What about LIC? Somebody is asking you on this is LIC loss is compulsory. What is your view on LIC?
So LIC, again, they have a lot of, insurance policies and LIC Jeevan Anand. And that is what I try to talk about this because I've seen a lot of doctors actually buying insurance policies that are not required. So this is personally my experience. And we discussed it in the presentation also. You don't need anything other than your term plan, a basic term plan, a health insurance and a professional indemnity policy. So if you're buying a ULIP or a guaranteed pension plan or guaranteed income plan, it is a complete big no from my side, honestly. Please do not get into these products. They are most missold products. So strong recommendation to avoid them.
Basically, LIC is for security after your death. Return-wise, they are not very good. And all of us have so much of asset up to the age of 60. Your amount in LIC is negligible, which is useless. So unless you want to have something for security in the case you die early, These are the things where they recover well. So you get some money as an insurance that in case you die early, the beneficiary will get. Otherwise, over a period of time, returns are not so good. And considering the wealth you have in 60 years of your life, this amount is extremely negligible. So I don't believe in LIC.
Quite right. What is rightly said is mainly it is for the after that your own relatives who will be benefiting. So there is no point, as Arpita madam also said, you should not go in for returns purposes. It's only for guarantee for the family members who are going to benefit later on, right? No,
Treat LIC basically as an insurance. Don't try
right.
to buy
Rather than
investment in LIC
yeah,
through LIC. Keep
not
your
as an investment.
insurance, yeah.
Yeah.
Keep your insurance
Right.
and investment separate, and that is the best thing that you can do for your money.
Quite right. Regarding mutual funds, what you said, one is the hybrid one. Which are the other ones other than hybrid which have better returns as good as equity?
So as good as equity, that's a different topic, honestly. So, sometimes, the sky is the limit. Sometimes Bitcoin is also giving better returns than stock market. So that does not mean I want to, right now, the entire topic that we're trying to discuss is I want FD plus returns. I want better than FD, inflation matching or slightly beating inflation. And I want to contain the risk. I don't want to increase the risk. I don't want to fall into negative return territory. Maybe because I am an ultra HNI investor with a lot of exposure into equities, or I'm a faint hearted person. So that is okay. That is
Quite
when
right.
you go to a hybrid mutual fund. Hybrid mutual fund, there are subcategories to hybrid mutual fund, but the broad category when you go for such kind of requirement is a hybrid mutual fund.
How do you define a hybrid mutual fund exactly? When the
Hybrid
people will start choosing it, how do you go and choose the hybrid mutual fund?
So
There are so
hybrid,
many, as you said, 190 plus are hybrid mutual funds.
correct.
How do
So
you choose in that?
very good question. Very good question. So there are 190 plus hybrid mutual funds. So the best way is actually if you can understand number one, what is your requirement? Understand the first subcategory. Do you want a conservative hybrid fund where you want the equity exposure to as low as 10-20%? Or do you want to just hand over the baton to the fund manager and take his call? And number two, try to understand what has been the past performance. And the best way to understand the past performance is not via point to date returns or trailing returns. The best way to do that is to find out what has been the rolling returns since inception for 3 to 5 years. So try to understand what are the rolling returns over a period of 3 years, over a period of 5 years. Understand how has the fund manager been able to perform in bear markets, perform in bull markets, and that is the best way. Don't walk into an SBI branch and just buy a SBI hybrid mutual fund. Either do your own study and understand which is the hybrid mutual fund for you, or speak to an investment expert and let him build a portfolio of hybrid mutual fund. You should ideally have 2 to 3 hybrid mutual funds in a portfolio, all of them across different mutual fund companies. So don't buy all 3 hybrid mutual funds of ICICI. If one is of ICICI, take one of HDFC, then take off one of Edelweiss. Don't just go and handpick. Try to either build an expertise or go to a person who has an expertise and create a diversified hybrid mutual fund portfolio over there.
Quite right. Over to you, Viral. Any questions you'd like to ask? There are many in the chat box.
Sir, there are some questions on the panel. Dr. Avesh is wanting to know how about NPS tier 2 as an alternative to mutual funds?
Okay, so NPS, the problem is the variety is not that much. The kind of variety that you get in mutual funds, the variety is much more. And so NPS tier 2, definitely the lock-in period and those restrictions are not there. But the number one, and even if you see performance-wise, mutual funds in the same category, peer-to-peer analysis, mutual funds are faring much better than NPS.
Okay. And Arpita, your opinion on RBI bonds? Dr. Santosh Bhide, sir, wants to know your opinions on the RBI bonds, please.
RBI bonds are exactly like senior citizen savings scheme. So they are giving you 7.5% per annum. But again, that is simple interest.
Simple interest, quite right.
Yeah, so that is again a creatively marketed product, but essentially it is a bank FD. You're losing money there, so avoid.
Very good tips, huh? Was very personal tips. Even I was not aware the RBI bonds are as good as a bank FD.
No,
Good.
no, there is a small difference here. That's if Arpita doesn't mind. The money which you get, the whole idea of this senior citizen is that you get about 22,000 or 23,000 on 15 lakhs quarterly. So you can use that money for your as a senior citizen. Or if you cannot, if you don't want to use that money, you can put the same money into regular FD. So if you
Then
calculate
again,
the
the interest that you're earning here, pardon me, but the interest that you're earning through senior citizen savings scheme or RBI bonds, you will again reinvest it at not more than, like, you won't get an investment product where you can invest it at 7%.
it will be 5.5 or 5.7,
Exactly.
whatever.
The effective return is not 7%. It's not more than 5.5%, even if you're reinvesting your return. That is the entire point.
And the lock-in period is big.
RBI doesn't
7
have
years.
most of the time. I don't think RBI has got a locking period.
Yeah. Dr. Santosh wants to ask if hybrid funds also invest in the FDs, then why we should invest in hybrid funds?
Hybrid funds invest also in stock market. They invest in equity market also, and
there
they
is a
have
ratio.
to help you increase your that is how they give you FD plus return. They're not giving you FD return. They're giving you better than FD return.
Basically, hybrid fund, they decide the timing. You know, if the time is bad for the stock exchange, they shift the money to other things. If the stock exchange is good, they shift money from here to there. That is what the hybrid fund is. Whichever is the best thing, they will decide for yourself.
How is hybrid fund different from the regular funds, Arpita ma'am?
So we just discussed that, mutual funds, there are a lot of type of mutual funds. Equity fund is investing only in stock market. So like 95, 98% of the amount is invested into stock markets. Of course, the risk is tad higher. Hybrid mutual fund, they're investing into bank FD also, corporate FD also, RBI bonds also, and investing into stock market. So they're getting basically best of both the worlds and putting it up for you.
That's why the volatility is less.
Volatility is much less.
Much less.
Practically not there.
Yeah. There is a question for RC sir. RC sir, Dr. Dhawan wants to know what are the currently investable sectors or stocks?
Can I speak, madam? I have to take the permission from madam and doctor.
I'm nobody to give you permission, sir.
I'm giving you. So don't worry.
Yeah, we are all waiting for RC sir tips since last 3 years. Whatever tips that RC sir gives, we blindly follow. Yes, sir. RC sir.
See, the next, what I feel that there will be definitely alternative to the oil. People are fed up of this blackmailing from the oil countries. So you will have a substitute of oil. The industry involved in this oil and the immediate beneficiary will be alcohol. So all the sugar companies which has got a good balance sheet with low depth and everything, when they have a large quantity of alcohol they are making it, I think they will do the best. They will give you a return very well. What we have seen in 2020, something similar it will happen. You all remember our sugar was told at 200 rupees. Now it is 750. And I purchased 4 days back again. The second one which I purchased was Ugar sugar, where they have increased the alcohol capacity from 2 lakh liters per day to 4 lakh liters. And probably they might declare about 20 rupees earning per share. It is available at 79 rupees, 1 rupee share. These are the two. Dhampur sugar is another one, which is going to be a great beneficiary. And this process of alcohol consumption is going to be there for next 3 to 5 years. And the other thing is electric vehicle is another one, but it will take a long time for electric vehicle to replace. Hydrogen will take 3 to 5 years to get implemented. So in these 3 to 5 years, the only alternative energy is the alcohol. The second one is alternate energy is the solar power. So I have not bothered about the solar, but the components which are used to make the solar panel. And one of them was told to you was Polyflex at about 600. Now it is 2,500 rupees. The second was on Uflex, which was told at 200 rupees. Now it is 700 rupees. And still we can go for that because they are manufacturing the plastic. and that is used in this manufacturing of these solar cells. So that are two things. Other thing which we have told is solar pump, the Shakti pump, which was at 200 rupees, now it is 550. It went to 900 rupees.
900,
Still
correct.
it is still worth it. And I'm still holding the percentage. I have not sold a single share in that company. So these are the few things which are likely to give a huge benefit in next 2 to 3 years. You have to just think that way. Everything is very simple. If you understand the basic common sense, you can invest directly with very good returns.
What about Ruchi Soya, Ramesh bhai?
It's a highly
Ruchi Soya,
speculative. I don't want to enter into this.
correct.
But they
Any
should
Baba?
do well because they have paid the debt. They have become a
Yes,
debt. And the
debt-free
soya
company
is any agriculture product, any agriculture will do well
Okay.
for next 3 years. We have purchased that one more, all the rices. One of them was, which one was that, which was at 14 rupees and now it has become 45.
Rice ka?
Rice ka. It is a Kashmir-based company. We have
Yeah,
purchased. Most of the things which you have told last, Servicer Food, sorry. Somebody-
Sarveshwar, correct.
Still they are, I think they are doing very well and it should give a multiple return in next 2 years. So if you are ready to wait in mutual fund for 2 to 3 years, even if your selected stocks go down, you wait and see what happens in 3 to 5 years. If your concept is good. If your concept is not good, then it is difficult.
Strong
Correct, sir.
fundamentals, we should go for it, correct.
You should go for it. And you can get all these things on net. There is a website called screener.in. You get
Yeah.
all the things detailed. You can pay them and they will also help you to give you all the data available.
Right. What about Bajaj Hindustan
I have not sold it.
and specialty chemicals?
That is, I think the Teji is over.
Over.
We
Okay.
have exited from that.
Oh. So very nice. I think
One more
lots
thing,
of-
one more, if you don't mind,
Bolo.
one more thing, the defense sector has opened out.
Yes.
So this is one thing which I think I thought of last year. I purchased HAL, Hindustan Aeronautics,
Hmm.
which was my purchase price was 900 rupees. Now it is 1700 rupees. And I am not
Correct.
sold a single share. HAL, that is Hindustan Aeronautics. The other
Aeronautics.
one is Garden, I think it is Garden Reach. The third one which I thought of is Mazgaon Dock.
Has gone down, correct. It is short of like anything now.
No, it's not gone up that much as expected. It is not, it has just doubled. It's not become 5-10 times. But they can become 5-10 times.
Correct.
So these are the few things where I put all my money into this. I have kept some amount for my retirement. The rest, all money is lying in the stock exchange. And I'm a very risky person from the beginning. We have told you about the BCG. You remember BCG?
Yes.
BCG was told at 3 rupees and 30 paisa. It
Ah.
went to 200 rupees.
Okay.
So
As
you have to understand the business, take the risk if you want. Otherwise, mutual funds are always there to give you a good return, more than what the FD gives. But I am a risky person, so I always take the maximum risk.
Yeah,
Because
those
we
who
all
are
have,
averse to
we
risk,
all,
I think mutual fund is the best thing. But
We-
if you are ready to
the-
take the risk and if you have the strong fundamentals with you, I think stock
Next-
market is the way.
next 2 years, I personally feel that you should remain in stock only. And after that, once everything settles down, you shift the money somewhere else. There are so many, same mutual fund, hybrid fund. We did last 5 years back, we shifted money from there to here. So you have to learn from where to go in the money. And all of us have so much of income, which is at our disposal. I think you should take the risk in stock exchange. If you want to make big money, if you don't want to make big money, then it's okay. You can continue with mutual fund.
Regarding silver and gold, I think it's a perpetual talk.
Silver is not yet,
discussion on
silver
that.
did not,
Always prefer silver.
silver did not give us a good return
Yeah.
so far. It was recommended last year. It did not give hardly
Correct.
anything.
I
But
think two sectors that we are personally very bullish when you're talking about stocks is banking and financial services, which has actually been a laggard, but the credit growth has actually come on the papers. The earnings growth has actually come on papers. So, banking stocks like Axis Bank, they've all started rising, and it is a very good time to invest into banking stocks. And the second theme that we're bullish, our company personally is bullish on, is capital goods, infrastructure, home improvement theme. So these are the two sectors that I'd like to actually, I'd like to add these two themes to Dr. Shah's recommended themes list.
What about chips? Chips, the semiconductor chips.
It will take time for us to produce. It takes 2-3 years to produce.
Uh-huh.
And one of them is who has done is very good is that Vedanta.
Moss chip.
Vedanta. Most chip you have
Vedanta.
purchased at 50 rupees. 40 and 50 rupees over purchase price. Now I think it is even this thing which was told to you, that was at
Moss chip.
drone, one of the drone company, which was recommended at 50 rupees. Now it is 160 rupees. The only listed drone company, I don't remember now. It is still, I'm still
Madam
holding.
must be knowing, na? Drone company.
I'm not able to remember.
Okay.
The other thing which he said about the banking, I personally feel that the safest one is JK Bank.
Is JK Bank?
Yeah.
You are not bullish on Axis, ICICI. I know ICICI already.
They are overpriced. They will give you 20-30%. JK Bank will give you 500%.
Ratan
India
is
Ratan India is what Dr. Sanjay Dhawan has just mentioned.
Yes, correct. Monopoly
That
item.
is the drone company.
So yeah, there is a question for CA Arpita. Is it only hybrid funds, hybrid mutual funds that are recommended for this particular niche that we are talking about, or there are any other options other than the hybrid mutual funds?
So particularly the thing that we are, if you have that requirement of containing your risk, decreasing your volatility and getting FD plus returns, then hybrid mutual funds are the best options. The secret is you have to stay invested for 3 to 5 years. And the second secret is you should pick the right funds, pick the right portfolio. So yes, these are the best these are the best investment options for this kind of.
For picking, I think you have.
Sir, so what is the right age group for a doctor who should think about this hybrid mutual funds? Which category of doctors in what age group?
Okay, so we're a strong believer that your age does not define your risk appetite. We are a strong believer that your investment options should be actually driven by the kind of time you have in hand for the money that you're investing. So if you are staying invested with that money, if you can stay invested for 3 to 5 years, if you have a financial goal that you want to meet out of that money after maybe 3 years, 4 years, or exactly 5 years, college, your kids' education or whatever kind of expenses, but you have a fixed timeline that, I need this money back in 3 to 5 years, then it is a hybrid mutual fund category. But if you can stay invested for more than 5 to 7 years, regardless of your age, regardless of any other thing, then you should ideally go for stock market, either via way of equity mutual funds, PMS, AIF, direct stocks, whatever. But the ideal way is, if you want to invest into stock markets, try to keep your time investing horizon to more than 5 years.
Does this hybrid mutual funds also give the options of SIPs?
Yes, they do.
Okay. And which is one of the best hybrid mutual funds as of today that you would recommend to a doctor? That is one of the questions asked on the panel. Yeah.
So again, we're a strong believer of customized investment portfolio for each person. We're a strong believer that like every patient cannot, with the same disease, he cannot be treated with the same medicine. The same way, every person cannot have the same portfolio. He works on a different financial cushion. He has a different financial cushion. He has a different financial goals. He has a different risk tolerance level psychologically and financially. And that is why we are a strong believer that, the right hybrid mutual fund is different for everyone.
Correct. So the top 3 hybrid mutual funds, according to you as of today, top 3 in the market?
There are no top 3. I just said we don't believe in top 3, and we don't believe in value research or any of those Morningstar ratings. It is all customized to everybody's requirement.
And these hybrid mutual funds are in the market since how long? How many years?
Since mutual funds are there. So, hybrid mutual funds, some of them are as old as 15 years, 20 years.
So they doesn't require any other regulatory mechanism?
They're regulated by SEBI.
They have to take a special license for these hybrid MFs, or the same license of MFs apply to them?
Same FM license.
And they don't
Any
have to.
website,
They
any
don't have to.
website which gives.
They don't have to
Yeah.
disclose. Yeah, just a second. They don't have to disclose their holding percentage of everything or
They do,
every quarterly.
they do
They have to-
every month.
Every month. Okay. Fine. Sir, Taswala sir.
Yeah, which are the good websites to study all this? The way you said, of course, the financial consultant is one. The
Sir,
PMS
website
people.
is there already on your screen, sir.
No, no.
नहीं
So
नहीं that is Nivesh Mitra तो है ही,
there
but
is,
otherwise
we don't provide research like this.
Okay.
We don't have a website that gives you research. But anyway, go to any website. I'm not recommending any website, but try to avoid trailing returns when you're picking it. Try to get rolling returns. Now, it doesn't matter आप कहाँ से लेकर आ रहे हैं rolling returns, but the idea is it has to be correct, and please focus on rolling returns and not trailing returns. You can get it
Yeah.
on a lot of websites, but try to focus on the right parameters when you're analyzing. Analyzing is also a skill, so try to analyze on the right parameters.
yeah, a good website which give it the way screener.com they gives about equity. Which are the mutual fund sites which give you the trusted proper rolling returns and all the other parameters? That is
So
what I asked.
to be honest, we don't see rolling returns on any website. We have our own internal data sourced by ACE Mumbai. So I'm sorry, I cannot. I myself don't know a website about it because we are working on our own research software, which is available to advisors. So I'm the wrong person to ask this question.
Okay, fine. Dhanvir Saraf has raised his hand. I think he can unmute and ask, please.
Dhanvir, you want to ask some question? You can unmute yourself. Yeah, please go ahead.
I would like to have views of Dr. Ramesh and Arpita about NSE affair which is going on.
About
NSE affair.
NSE affair.
Yes.
We are not in anybody expert to talk about this disputed
Yeah.
case.
Does it affect the normal share people who are invested in equity?
No, I did not get the question.
Arpita, can you help him?
No.
Okay. I think you'll have to choose another forum to answer your question.
Yeah, we are not the regulatory body to comment on it. It is all
Yes,
gossip.
doctors trying to learn. It's an educational
It is
forum.
all hearsay and what we read in the papers only. Yeah.
Yes. Okay.
So any other questions from the panel, sir? You are seeing any questions? Jignesh, sir?
No, nothing more. I
RC,
think
sir,
we
you
have
want?
to
RC, sir, RC, sir, your final parting comment, sir?
Yeah, I was just going to ask.
Stay invested in a whatever way you like.
Yes.
Keep
Whatever
some
you are
money.
comfortable
See,
with.
what I do is next 15 years, if I'm going to survive and I need this much money, that money is kept in FD. The rest of the money is shifted. Even the real estate might do well in next 2 years, especially two companies. One is Prestige. The second one we already recommended in that is that Oberoi. These two things should do well.
Oberoi,
So
which
we
is
are
the
very
first
well
one?
managed companies.
Bhai, first one, kahi?
First one was Prestige.
Prestige, okay.
It is, I think, 600. We told at 300.
Oh,
And second one is
Oberoi Reality.
Oberoi.
Okay, okay.
These two things should do well because the number of registration, they are really doing well now.
Okay.
These two companies should do well.
See, Arpita?
Right.
Yeah,
Arpita, madam.
Yeah, you want to put in your final word, comments about today's program?
Messages.
Yeah, please go ahead.
Just take an informed decision about your money. It's a very hard-earned money. So don't get into mis-selling products. Please try to educate yourself as much as you can. I understand we all are working on limited timelines, but just educate yourself a little at least about your money. So either you handle it yourself or hand it over to an expert, but at least take an informed decision about your money. It's very important.
Yes.
Yeah. So I think very well said, Arpita madam, and of course, Mara RC bhai is always there to guide us throughout, whether you are part of the webinar, but we have our groups which are already existing for the last almost 3 years. And he is a good guide to us, and that's why he's a special invitee. Any question about investment, he is a best guide, more so in equity. And that is how he is here. I actually wanted his comments with mutual fund. So he rightly said, he is a person who is a very high risk, so with a very high risk appetite, and more so he would like to go in for equity. So that is of course his baby. Everybody should take a call according to his appetite. What rightly Arpita madam said. Today's topic, of course, those who are not high risk and you are averse to high risk should go in for mutual funds, and mainly the hybrid one, which gives better returns than the FDs, and you are at peace. So that is what I would say. A big thank you to RC Bhai, Arpita madam, and Viral Bhai for conducting
Sir,
and moderating the session.
our MOS
And of course,
secretary, MOS
our
honorary
MOS
secretary has
secretary, Dr.
joined, sir.
Rajesh Joshi, the backbone of MOS,
Yes.
and Dr. Rajiv Mundra, the treasurer, जो पैसे देने
Uh,
वाला वही
I
है. So
I
they
now
are very
invite,
much
yes,
here.
sir. Jignesh sir,
And
Jignesh sir.
हाँ
Hello.
बोलो, हाँ
Sir,
बोलो.
now invite our secretary of MOS, Dr. Rajesh Joshi sir, to give a formal vote of thanks on
Yes,
behalf
yes.
of
I was going to tell you that, tell him that only, Viral.
Yeah.
Yeah.
Anyway,
Otherwise,
over to you,
also,
Rajesh Bhai. He
yes,
is
I am
the
not
backbone of
friendly.
MOS, and always the way he gives the Thanksgiving, nobody can give it. So over to you, Rajesh.
Yeah, I think today was fourth meeting of financial committee, and I am not very friendly with investment. But after listening to financial experts, I think I'm going to try to study finances and investments. We can go on and on when it comes to finances and investment. We all are interested in our investments and finances. Thank you, Arpita madam, for touching most important point, that is inflation and how to deal with it. Dr. Ramesh sir, I heard you many times in conferences from podium about your innovations, but today I came to know about other side also. Thank you for your valuable inputs. And I think we would like to have you in our next sessions also. I applaud the initiative of President Dr. Jignesh Taswal and request him to have more sessions on finances. Thank you, Dr. Viral, for conducting the session so well. You made it so vibrant. I'm also thankful to all those who are joined on virtual platform and interacting actively. Thank you and good night.
Yeah. And I assure you, as Dr. Rajesh Joshi said, we are going to continue the financial series, maybe once or twice a month, depending upon the needs of our august audience. And surely we are extremely thankful once again to Arpita madam. So readily she has agreed. Harshit had called me up, okay, sir, what would you like to have? So you have served it on a platter. Big thank you to you. And all of you have joined, and of course, Ramesh Bhai, Dr. Viral, and Rajesh. And
Thank you,
of
sir. Thank
course,
you.
Rajiv Bhai. Bye, and take care. I think people are still joining. I wish
Yeah,
to admit
still
it,
there.
people thinking that it's a
You have to
perpetual
send,
session.
yeah, Jignesh sir, you have to send the recording link to everyone now.
Yeah, Arpita ma'am, as it is on your platform, I would request, I had already told Harshit, once it is over, please pass on the link and the full recording to us so I can share it with our
Sure. You
members.
send the recording link tomorrow.
Yeah, link and the
Thank
whole
you.
recording also in
Yes,
case
the
this
file.
thing
Yes.
doesn't work.
Yes.
Thank you.
And
Sir.
more of you later on. Thanks a lot and take care, everybody.
Thank
Good
you.
night.
Good night. Good night. Good night.
Good night.
Good night, sir.